Hello friends, welcome to Business Hologram YouTube channel. Today we will be doing the company analysis of CEAT Ltd. So let's get into the company overview. CEAT Ltd is the flagship company of the RPG group. It is one of India's leading tire manufacturers with a strong global footprint. It was originally established in 1924 in Turin, Italy. It was acquired by the RPG group in 1982 and is currently headquartered in Mumbai. So we will now look at the market capitalization of the company, approximately 10,700 crores as of April 2026, and it falls into the mid-cap segment. Other details includes key management. Current chairman is Harshvardhan Goenka and managing director is Arnab Banerjee. And the current stock price, last traded stock price is rupees 3,800. And if we look at the 52-week range, the highest price reached 4,438 rupees and the lowest price was at 2,984 rupees. So that was a brief company overview. Also, we will look at the different portfolio, the product portfolio of the company. The product portfolio includes tires, tubes, and flaps for a wide range of vehicles, including passenger cars, two-wheelers, trucks, buses, light commercial vehicles, and agricultural or off-road equipment. So it has manufacturing facilities in Maharashtra, Gujarat, and Tamil Nadu, and it exports to over 110 countries with a significant presence in Europe, North America, and South Asia. It also operates a joint venture, CEAT Ltd, in Sri Lanka. So now let's look at the financial performance of the company for the last 4 quarters. The financial performance, if we analyze, we can see that it shows a consistent upward trend in revenue with recent quarters benefiting from strategic acquisition like Camso and improved domestic demand. So in the screen you can see the parameters like total revenue, net profit, and earnings per share. So what we can mainly derive from the data is that in Q3 FY26 was a standout quarter with 26% year-on-year revenue jump, while profit was slightly lower than Q2 due to a 58 crore provision for new labor codes. The underlying operating leverage remained strong. If we look at Q2 FY26, it marked the full integration of the Camso brand effective September 1, 2025. This helped the company achieve a significant 52.9% year-on-year growth in net profit. So Q1 FY26, we can see that the revenue grew by over 10% year-on-year, though PAT saw a dip compared to the previous year's high base, primarily due to rising raw material cost at the start of the fiscal year. The last quarter that we are looking at is Q4 FY25. The company crossed the 13,000 crore annual revenue milestone. The board also approved a dividend of rupees 30 per share for the full year 2024-25 during this period. Now let's look at some of the strategic initiatives of the company. First point that we are discussing is off-highway expansion. In late 2025, CEAT acquired Michelin's Camso construction compact line business, including plants in Sri Lanka, significantly boosting its global presence in the off-highway tire segment. Next point is capacity expansion. The company is currently investing approximately 1,300 crore to expand its Chennai plant, bringing the cumulative investment in the facility to 4,800 crore. Next, let's look at some of the awards and recognition received by the company. First is the Deming Prize, the first tire company outside Japan to win this prestigious quality award. Next certification or the prize is Lighthouse certification, awarded by the World Economic Forum for its Halol and Chennai plants, recognizing leadership in fourth industrial revolution technologies. Next, point that we are talking about is the brand presence. CEAT is the official tire partner for German football club Bayer 04 Leverkusen, uh, and a prominent sponsor of cricket and the Indian Supercross Racing League. Now let's look at the ownership structure of the company. As you can see in the screen, the promoters hold 47.29 percentage of the shares, mutual funds 17.65, foreign institutional investors 16.55, insurance companies 2.49, retail and others hold 15% of the shares, and other domestic institutions around 1%. We can see the key highlights, that is zero pledging. The promoters have 0% of their shares pledged, indicating high financial stability and control. Next, combined institutional holding FII plus DII remains high at approximately 37.45, reflecting professional confidence in the company's long-term expansion strategy. Major promoter entities include Instant Holdings Limited, Swallow Associates LLP, STEL Holdings Limited. Key institutional holders include the Mirae Asset Nifty Total Market Index Fund, HDFC Mutual Fund, the New India Assurance Company. Now let's look at the financial ratios of the company. First, we will begin with the profitability ratios. As you can see in the screen, first ratio that we are considering is the operating margin, that is the EBITDA margin. So CEAT's value stands at 13.41%, where the industry average is 11.12. So we can clearly say that it is outperforming in this aspect. Next, we look at the net profit margin. The CEAT's value stands at 3.72%, where the industry average is 8.73. In this aspect, it is clearly underperforming. This is the result of the expansions that the company is doing. So the net profit has depreciated. Next, if we look at the return on equity, the CEAT's value stands at 11.24%, where the industry average is 19.35%. In this aspect of also the value is below average. It reflects significant capital deployment in the new Chennai and specialty plants. Return on assets stands at 5.24, where the industry average is 6.93%. In this aspect also the company lacks the industry average due to heavy asset base compared to the competitors. Next, we will see the return on capital employed value. If we examine the return on capital employed, the company's value stands at 15.4%, and where the industry average is 16.8%. It is near par in this parameters. So that's all about the profitability ratios. Now let's look at the major leverage ratios. First, we'll discuss the debt to equity ratio. For the company, the value stands at 0.65, where the industry average is 0.6. So it is almost in line. Moderate leverage, significantly healthier than some of the peers like JK Tires. Interest coverage ratio stands at 3.5, where the industry average is 5.5. In this aspect also the value is below average. It is mainly caused due to higher interest burden from the loans taken for the global expansion. Now let's see the valuation ratios of the company. First, we look at the price to earnings ratio. For the company, the value stands at 28.67, where the industry average is 22.45. So it is trading at a slight premium value. Price to book value stands at 3.44, where the industry average is 2.85. In this aspect also the value is at a higher side. Next, if we look at the price to sales ratio, the value of the company stands at 1.14, where the industry average is 0.95. In this aspect the value is at a moderate level. Now let's move to the SWOT analysis of the company. Firstly, we will be discussing the strengths of the company. First point that we consider under strengths is strong brand and distribution. A dominant player in the Indian market with over 4,500 dealers and a massive presence in the replacement market. especially in the two-wheeler and passenger car segments. Next point is technological leadership, holding lighthouse certification from the World Economic Forum for its Halol and Chennai plants, a global benchmark for fourth industrial revolution tech. Next point is diversified revenue streams. Strong presence across original equipment manufacturers, replacement, and exports, reducing dependence on any single channel. Next point is EV market leadership. Currently holds over 30% market share in the passenger car electric vehicle segment and 20% in two-wheeler electric vehicles in India. Next point is zero promoter pledge. The RPG group maintains 100% of its stake without any pledging, signaling financial health and long-term stability. Now let's look at some of the weaknesses faced by the company. First point that we consider is high capital intensity. Continuous heavy capex keeps the ROC under pressure compared to leaner peers like MRF. Next point is lower net margins. While operating margins are strong, higher interest costs from expansion, loans, and depreciation impact the final net profit margin. Next point is raw material sensitivity, highly vulnerable to fluctuations in the prices of natural rubber and crude oil derivatives, which makes up 60% of its production costs. Now let's look at the opportunities in front of the company. First point that we're considering is specialty tire expansion. The recent acquisition of Camso and the establishment of CEAT GmbH Germany in April 2026 positioned the company to capture high margin off-highway and agricultural markets in Europe and North America. Next point is premiumization trend. Growing Indian demand for SUVs and high-end motorcycles allows CEAT to push higher margin, larger rim-sized tires. Next point is digital transformation. Recent investment in tires and more enhances their direct-to-consumer play and digital footprint. Tires and more is an online tire services application. Next point that we consider is infrastructure push. The 11.21 lakh crore infrastructure allocation in the 2026-27 union budget serves as a major tailwind for the commercial vehicles tire segment. Now let's see some of the threats in front of the company. First point is US tariff risk. The 26% reciprocal tariff negotiation remains a high and key watch point for the export heavy companies like CEAT. Next is intense competition, aggressive pricing strategies from domestic peers like Apollo, JK Tires, and the return of global brands could lead to price wars in the passenger car segment. Next point is global macro uncertainty. Geopolitical tensions impacting global supply chains or shipping costs can skew export margins. Next is FII sentiment. As of April 2026, the company has seen some selling pressure from the foreign institutional investors due to broader global risk of sentiment. So friends, that's all about the company and stock analysis of CEAT Limited in a nutshell. If you found the video useful, please like, subscribe, share, comment and support. Thank you.